Hello friends, today we are going to discuss about another topic, governance of finance by banks and financial institutions. So before going to talk about the governance of finance, first we are going to discuss about the meaning and definition of banks and financial institution. Financial institution is the most general term corporations that provide services as intermediaries of financial markets. The most common financial institutions are banks. It is widely accepted that credit is a phenomenon of economic development and the banking system, along with entrepreneurship, is a vital agent which plays a crucial role in the process. A bank is a financial institution that accepts deposits from the public and creates credit. Simply, it can be defined as the business activity of accepting and safeguarding money owned by other individuals and entities. It is formed for the purpose of maintaining current accounts, saving accounts, and checking accounts, issuing loans and advances of investment and credit, and dealing in negotiable securities issued by the governmental entities and corporations. The next aspect is objectives from the viewpoint of banks owners. One is earning profit. Second one is rendering services. Third one is investment of fund. Fourth one is earning goodwill. And fifth one is raising efficiency. In continuation with the definition, according to Grover, a bank is a dealer in debt, his own and other people's. In another personality, R.P. Kent says, a bank is an institution, the principal function of which is collect the utilized money of the people and to lend it to others. In case of financial institution, an enterprise such as bank whose primary business and functions is to collect money from the public and invest it in financial assets such as stocks and bonds, loans and mortgages, leases and insurance policies. The objectives from the viewpoint of the governments are issuance of notes and currency notes, formation of capital, investment of capital and industrialization, control of money market, creation of employment, counseling in financial matters. The next aspect is objectives from viewpoint of bank customers. Safe custodian of public money, custodian of public money, representative or trustee providing credit facility. The next aspect is features of banks and financial institutions. The following are the key features of banks and financial institutions. Lending, which includes personal credits, mortgage credits, factoring, etc. Financial leasing, venture capital financing, issuing and administering means of payment, guarantees and commitment, trading for own account of customers, underwriting shares issued and participation in such issues, money brokering, issue of electronic money. Next aspect we are going to discuss is the Indian banking system. Banking industry in India has transformed a very long path to assume its present stature. It has undergone major structural transformation changes and there has been phenomenal expansion of branch networks. Banking system grew tremendously in terms of numbers of offices, magnitude of bank deposit and bank credit. The evolution of banking lasted for centuries. Banking system evolved to meet the expansion that began at the same time. The next aspect we are going to discuss here is disbursement and recovery of loans. The actual delivery of funds from a bank account or other funds. It is a payment made by a company in cash or any other modes of cash. It is for the definite period of time, maybe a quarter or an year. It is that process in a loan where one gets funds after the loan is approved. Approval of loan also depends on various factors like verification of documents, credit score, income and repayment ability. The banker is also required to see that the money advance is also being recovered properly. Next one is the precautions for recovery. And some other aspects are proper selection of the borrower, viable projects, proper assessment, consumption needs, no dues certificate, provision for repayment, proper repayment schedule. The next aspect is precautions after disbursement of loans. In case of banker is satisfied with the appraisal of the loan application, he sanctions and disburses the loan to the advances. The banker should particularly check and focus on the end use of the borrowed funds. The next aspect we are going to discuss is sources of funds for banks. A bank is a financial institution that helps community members open current and savings account and manage money market accounts. However, as the name implies, a bank also has a broader business-oriented focus. Most banks offer business loans and trade financing in addition to more traditional deposit, withdrawal and transfer services. With such a diverse business profile, the sources of funds in commercial banks are varied, some of which are defined below. Number 1, saving deposit. It offers highly liquidity and is very popular among the masses. They provide a lot of flexibility for deposits and withdrawal of funds from the account and also have check facility. The public sector banks offer an interest of only 3% on savings account. However, some of the private banks like S Bank, Kotak Bank offers the interest rate between 4 to 5%. The next type of deposit is recurring deposit. It is a special type of term deposit where you do not need to deposit a lump sum savings. Rather, a person has to deposit a fixed sum of money every month. These accounts have maturities ranging from 6 months to 120 months. You can also give standing order to the bank to withdraw a fixed sum of money from your savings account on every fixed date, and the same is credited to RD account. However, the bank may charge some penalty for delay in paying the installments. The next one is current account. It is a demand deposit and is meant for businessmen to conduct their business transaction smoothly. These are the most liquid deposits and there are no restriction on the number of transactions in a day. Moreover, banks do not pay any interest on these accounts. The next type of deposit is fixed deposit. It is an instrument offered by banks which gives a higher interest than a regular saving account and offers a wide range of tenures ranging from 7 days to 10 years. The rate of interest varies from bank to bank. Usually, it lies between 6 to 10%. You may or may not have a separate bank account to open a fixed deposit with the bank. You may be charged some penalty in case of early closure of FD account. However, with the focus of government to have a bank account for everyone under the scheme of Pradhan Mantri Jan Dhan Yojana, you can open a bank account for free if you do not have one and enjoy various facilities offered by banks. The next aspect is borrowed funds. The number one is repurchase agreement. A repurchase agreement, repo, is a form of short-term borrowing for the dealers in government securities. In the case of a repo, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day. For the party selling the security and agreeing to repurchase in the future, it is a repo for the party on the other end of transaction, buying the security and agreeing to sell in the future. It is a reverse purchase agreement. Repurchase agreement act as a borrowed sources of funds for banks. The next point under this is income from non-banking activities. Banks nowadays indulge in various non-banking activities apart from traditional services offered by them. These activities were earlier not performed by them. They generate income from these activities which act as a major sources of funds from many banks. The next aspect we are going to discuss is the problem and challenges faced by the banks. In the modern age of development, there are rapid changes in every field in India in which banks are not untouched from it. Recently, banks are playing a vital role in our economy, such as demonetization and cashless transaction, etc. Besides these features, there are a lot of problems and challenges faced by the banks. Some of them are discussed below. Number one, losses in rural branches. The main problem of the banks in rural area, the expenses such as maintenance of increase day by day. Most of the people are farmers and the laborers who lend the money for farming on a fixed rate of interest. Hence, their income depends upon agriculture, and if they fail to pay the borrowed amount to the bank due to not earning profit, they become insolvent and the banks or fails to recover their amount. According to 59th NSS survey, the household with the 2 hectares or less land accounted for 84% of all farmers' households. The percentage of such type of small and marginal farmers who have access to credit, only 46.3% depend upon the banks for their financial needs on total agriculture debt. To make agriculture sector, the RBI has removed the interest rate on the debt. This decision is very challenging for the banks to recover their amounts. The second point is NPA, that is a non-performing assets. So NPA is a big problem not only for the banks but also for the government. The gross NPAs of listed banks increased to 5.1% of gross advances between March and September 2015. According to RBI data, the information on central bank's website shows that as on June 2015, the gross NPAs of scheduled commercial banks was rupees 3,29,803 crores. This is 18.6% of the total estimated total expenditure announced in the Union Budget for the State Bank of India, who is the largest investor, announced 61% drop in profit for the third quarter of 2015 and 16. The bank announced the losses will continue for the future. The RBI report also said about the gross NPAs of public sector banks may come down to 8% in March 2020. The next challenges faced by the banks are competition. As we know that there is not a single industry which is not affected or face competition today. In this way, banks are also faced competition with many institutions in deposit and borrowing concern. The banks are facing a tough challenge from non-banking institutions which include mutual funds, private housing organizations, foreign banks and leasing investment institutions. They offer higher rate of interest on their deposit amounts. The fourth one is the government policy. Another problem faced by the commercial banks is government policy, the banking system. This is needed the result of demonetization. The smooth functioning of banks has been affected by quick call or decisions. Before 2 years back, when the government announced for demonetization and it was the time rupees 500 and rupees 1000 rupee note was absolute from the economy. This decision had created panic in public. It was a big problem for the bank to run its functions smoothly without refusing any person. The fifth point is political pressures. The smooth working of commercial banks and private banks have been affected by growing political pressures from the center and the state governments. Commercial banks often face lots of difficulties due to various political pressures. Such pressures are created in the selection of staffs and grant of loans and create in favor of some particular parties without considering their credit worthiness. The sixth point of problem is rapid change in technology. Today, technology are changing and growing rapidly in India and banks are also upgrading their branches. These type of changing create a problem for those employees who are not sharp in technical fields, and technology is a problem for the people who live in rural areas. The seventh problem is illiteracy or unawareness of the customers. Illiteracy or unawareness of the customer is also a problem for the banks. The banks withdraw the information public interest, but the public do not attention on it, such as limit of withdrawal of the currency in a week or in a month, limit of deposit of the currency, rate of interest, numbers of transactions, etc. It is happening because of their illiteracy or unawareness. The next problem is large overdues. Small branches of commercial banks are now faced with a new problem, that is large amount of unpaid advances to farmers. The decision of farmer central government to abandon all loans farmers up to the value of rupees 10,000 crores has added to the difficulty of such banks. The next aspect we are going to discuss is remedies for bank challenges. To tackle NBA, the number one point is improved governance of public sector banks and distance from them from the government. Public sector banks boards are still not adequately professionalized, and the government, rather than a more independent body, still decides board appointments with the inevitable politicization. Boards should be entrusted with all responsibilities of meetings. There is absolutely no excuse for banks to be left leaderless for a long periods of time, as has been the case of recent years. The date of retirement of CEO is well known, and the government should be prepared well in advance with succession. Outside talent has been brought in very limited ways into top management in public sector banks. There is already a talent deficit in internal public sector candidate in coming years because of habitus in recruitment in the past. This needs to be taken up urgently. Risk management process still needed substantial improvement in public sector banks. Compliance is still not adequate, and the cyber risk needs greater attention. The second aspect is improve the process of project evaluation. Bankers will have to develop industry knowledge in a key areas since consultants can be biased, so that they could conduct the evaluation criteria by their own. Real risks have to be mitigated where possible and shared where not. Promoters should be incentivized to deliver with the significant rewards for one-time execution and debt repayment. Financiers should put in a robust system of project monitoring and appraisal, including where possible careful real-time monitoring of cost. The incentive structure for bankers should be worked out so that they evaluate, design and monitor projects carefully and get significant rewards if these work out. The third one is strengthen the recovery process. Both the out of the court restructuring process and the bankruptcy process need to be strengthened and made speedy. The former requires protecting the ability of bankers to make commercial decisions without subjecting them to inquiry. The latter require steady modification where necessary to the bankruptcy code so that it is effective, transparent and not gamed by unscrupulous promoters. The next aspect is refrain from setting ambitious credit targets or waiving loans. Credit targets are sometimes achieved by abandoning appropriate due diligence, creating the environment for future NPAs. Proper care should be taken before targeting the credits. Loan waivers, as RBI has repeatedly argued, vitiate the credit culture and stress the budgets of the waiving state or central government. They inappropriately reduce the flow of credit. To tackle the rural losses, the second aspect, expansion of bank branches in rural areas and engage more and more business correspondents as well as conduct financial awareness programs. This would help in reducing financial as well as social crisis in rural areas. The third one is to increase transparency and accountability. Recently, the RBI Governor Sasikant Das has stated that to increase transparency and accountability, there is more need to focus on corporate governance norms. The set of corporate governance reforms proposed by Das include streaming of the board level appointment process, development of effective risk management systems, creation of a pool of independent directors, and setting up of mechanism to evaluate the performance of senior functionaries. The boards of banks should specifically pay attention to creating and sustaining a culture of effective control in banks. A suggestion has been put by the present governor to create an important risk management system in banks for which chief risk officers have to play an effective role and should be directly accountable to managing directors, chief executive officers and risk management committee of the board. The fourth one is to upgrade technological usage. India's banking industry is on the cusp of major transformation with new banking licenses expected to bring in more players in an already competitive environment. In such an environment, banks across India are increasingly adopting business intelligence and analytics to drive their overall profitability. The RBI has also encouraged banks to adopt BI to increase transparency and control over the banking business. The automated data flow initiative has been a strategic step in that direction, seeking to ensure submission of correct and consistent data from bank system to the RBI without any manual intervention. The fifth one is awareness and literacy among the people. Among the rural people, such customers lack the basic knowledge of banking. They need to be educated about the elementary benefits of banking. For this purpose, banks need to become to their door and make them understanding banking and its uses. The Jan Dhan Yojana is a classic example of such effort. Among the urban people, a large urban population do have a bank account, but banking uses differ from holders, age, and occupation. For example, elderly people are reluctant to use virtual banking. To educate them, several measures have been adopted. In order to explore innovative and participatory approaches to financial literacy, a block level CFL Center for Financial Literacy. The project was initiated in 2017 by the Reserve Bank across 80 blocks in 9 states. The project currently being implemented by 6 NGOs in collaboration with 10 sponsors banks. As at the end March 2018, 1,395 FLCs Financial Literacy Center camps were operational in the country. During the year ended March 2018, 1,29,280 financial literacy related activities were conducted by the FLC as against 96,315 activities during the preceding year. In order to create awareness at the large scale on key topics every year, the Reserve Bank had decided to observe 1 week in a financial literacy week starting from 2017. The next aspect we are going to discuss is ethics in finance, followed by entrepreneur. So before going to discuss about the ethics in followed by entrepreneur, so what is ethics? So ethics is concerned with the study of morality and the application of reason to elucidate specific rules and principles that determine right and wrong for a given situation. Ethics may be explained as a normative science of conduct, and conduct is a collective name for voluntary action. Voluntary action is an action which a man would have chosen if he had so chosen. Next aspect is importance of ethics. Number one is regulation of human behavior. Improving image and goodwill, long-term benefits, promotes balanced growth, focuses on sustained development, emphasizes on both means and ends, protects the employees and customers. The next aspect is role of ethics in finance. On a serious note, it is very important to realize that finance would be impossible without ethics. Finance covers a wide range of activities. The accountants are required to present a true and fair view. The picture that the accountant paints must be represent what is actually happening in the business. There are cases of innumerable number of organizations in India which have been cheated by many unethical people. These have resulted in deteriorating the confidence of the companies in the organization. The key features of ethics we are going to discuss here. Ethics involves selflessness, set of principles of personal and professional conduct. Ethics is a mother concept. Ethics is science of morality. Ethics is discipline of moral standards. Core question involved in ethics is right or wrong. Ethics addresses to rights and liberties, tries to set standard for ultimate end. It is concerned with human beings only. It is not legal, though it does not allow violation of laws. Set of systematic knowledge and human behavior related to judgment of value or what ought to be. The next aspect is the meaning and definition of entrepreneur. He is an economic leader who possesses the abilities to recognize more opportunities for the successful introduction of a new product. He is one who bears all uncertainty and risk. The definition of an entrepreneur has evolved over time as the world economic structure has changed and become more complex in nature. According to this text, the entrepreneur goes through the entrepreneurial process, which involves finding, evaluating, and developing opportunities for creating a new venture. He is like the sailor of a ship who decides the direction of the company. The next aspect is definition of entrepreneurs. According to Peter F. Drucker, an entrepreneur is one who always searches for change, responds to it, and exploits it an opportunity. He is both a pioneer and captain of the organization. An individual who takes the initiative to bundle resources in innovative ways and is willing to bear the risk or uncertainty to act. Entrepreneurship is the process of creating something new with a value by devoting the necessary time and effort, assuming accompanying financial, physical, and social risk and uncertainties, and receiving the resulting rewards of monetary and personal satisfaction. The next aspect is the features of entrepreneurs. Dynamic activity leads to innovation, profit trust, risk bearing capacity, generation of new ideas, act of feasibility, enhanced managerial capacity, creation of organization, prompt decision making. The next one is the quality of a good entrepreneur. Mental ability, number one. Number two is human relation ability. Number three, communication ability. Number four, technical knowledge. Number five, decision making ability. Number six, conceptual ability. Number seven, leadership ability. Number eight, convincing ability. Number nine, risk taking ability. And other aspect is the ethics in finance followed by entrepreneur. Working on the principle of ethics is required from the time of raising the sources to channelize them into most productive sources. Ethics finds its importance in every walk of life. Therefore, it cannot be ignored at any stage by entrepreneurs in promotion and development of their organization. Finance covers quite a broad range of activities. Two of main are as follows. One is financial markets and next one is financial operations. Ethics in finance are utmost importance as they bear on the financial well-being. Activities like insider trading and hostile takeovers raise unique issues that require special consideration. Few of the most unethical issues that should be avoided by all entrepreneurs in the process of business are sources of funds. There are multiple sources of funds from where entrepreneurs raise funds for investing in their business. They can be broadly classified into own resources and borrowed funds. Following is the list of enumerates the brief description of its sources. The next aspect is external sources. Entrepreneurs can take the loan that are either short term, medium term, long term. A substantial amount of entrepreneurial finance comes from loans. With this source of funds, entrepreneurs can address any liquidity crunch at times of asset financing, business expansion or diversification, etc. The another aspect is owner's equity. Owner's equity refers to the business funds that are provided by entrepreneurs themselves. However, this source can prove to be risky as the business owner puts his personal funds on the line. Such a source may also not suffice for funding, and unlike debt funding, it increases tax payable by the company as dividend on equity is an appropriation of profit, that is, it doesn't get deducted while calculating the net profit of the company on which tax liability is calculated. The next aspect is the external sources of finance. Number one is the venture capital. Number two, the angel investors. Number three, assistance from the government. Number four, commercial banks. Number five is business incubators. The owner equities consist of love money, personal investment. The next aspect is venture capital. A venture capitalist is an investor who provides capital to firms that exhibit high growth potential in exchange for an equity stake. VCs target firms that are at the stage where they are looking into commercialize their idea. Well-known venture capitalists include Jim Perrier, an early Facebook investor, and Peter Feinstein, an investor in Twitter. VC experiences high rates of failure due to uncertainty that is involved with the new and unproven companies. Angel investors. An angel investor is usually a high net worth individual who funds startups at the earliest stages, often with their own money. Angel investing is an often primary source of funding for many startups who find it's more appealing than other more predatory forms of funding. The support that angel investors provide startup fosters innovation which translate into economic growth. These type of investments are risky and usually do not represent more than 10% of the angel investors portfolio. To contact with angels, one has to keep a low profile and contact specialized association and websites on angels. They have personalized directory to contact with them. The next aspect is assistance from the government. Help facilitate walkable business districts, simplify local regulation for starting new period, dedicate resources to economic gardening, provide easy access to small business loan and grants, various schemes for young startups in India. The next aspect is business incubators. Shared basic operating cost, consulting and administrative assistance, access to capital, camaraderie of fellow entrepreneurs, internalized business incubators. The next aspect is commercial bank loans and overdrafts. Provides security to customers, money, and give entrepreneurs the opportunity to use their deposit to borrow more funds in order to run their enterprise. Growth of digital banking has reduced the cost of doing business tremendously. Banks have professional and specialized status and give suggestions regarding investment to entrepreneurs. The next aspect is owner's equity. Owner's equity refers to the business funds that are provided by entrepreneurs themselves. It is divided into two. One is love money. This money refers to that part of investment where the money is loaned by spouse, parents, family, and friends. Investors and bankers fall in the category of patient capital. This particular amount of money will be repaid when the profit of the business increases. The second one is personal investment. All the investment done either with one cash or with collateral to the assets. It proves to all the investors that all the savings invested by them in the bank will provide a long-term investment. The key features of owner's equities are: in case of entrepreneur invests on his own, it would have the following features: sources of permanent capital. They will not create any charge on the assets. They are very small denominations, no sharing of dividends. Finally, we come to the summary. Beginning from the acquisition of funds to channelizing them into the most productive sources, true and fair practices are meant to be adopted in order to stabilize their business and work for the growth and expansion. Emphasis on the ethical practices cannot be overlooked. Entrepreneurs cannot think of only earning profit and surviving in the market. They have to work for increasing the reputation and goodwill of the organization. This is not possible without giving importance to ethical practices. Thank you.